If you've saved $1 million or more in your 401k or IRA, congratulations, you're in the top 2%. You've done what most Americans only dream about. You maxed out contributions, stayed disciplined through market crashes, and built a nest egg that should set you up for life. But here's the problem most 401k millionaires don't see coming. The very success that got you here has created a whole new set of challenges. And if you're working with a traditional financial advisor who's focused primarily on managing your investments, you might be sitting on a tax time bomb that could cost you hundreds of thousands of dollars in retirement. Hi, I'm Megan Ramshaw, CFP and lead advisor at MOKAN Wealth. At MOKAN Wealth, our mission is simple: help self-made 401k and IRA millionaires keep more and pay less without jargon and generic advice. In today's video, I'm going to walk you through why having $1 million or more in pre-tax retirement accounts requires a completely different planning approach, and why most financial advisors aren't equipped to handle it. More importantly, I'll show you the 7 hidden tax surprises that are waiting for you in retirement, and what questions your advisor should be asking, but probably isn't. Let me start with something that might surprise you. According to Cerulli Associates, over 80% of financial advisors focus primarily on investment management and portfolio construction. Only about 15 to 20% provide comprehensive tax planning and proactive tax strategies as a central part of their service. What does this mean for you? It means most advisors are really good at showing you a diversified pie chart and talking about risk tolerance. They'll tell you you're allocated 60% stocks and 40% bonds, and they'll rebalance your portfolio quarterly. But here's what they're not doing. They're not looking at how every dollar you withdraw will be taxed. They're not modeling out your required minimum distributions at age 73 or 75. They're not considering how your Medicare premiums will spike when your income crosses certain thresholds. And they're definitely not thinking about what happens to your surviving spouse's tax situation after you're gone. I call these traditional advisors pie chart managers, because that's essentially what they are. And look, there's nothing inherently wrong with investment management. It's an important piece of the puzzle. But for 401k millionaires, it's just one piece. And frankly, it's not even the most important piece anymore. Here's the reality. Having $1 million or more concentrated in pre-tax accounts like your 401k and traditional IRA means Uncle Sam is your biggest silent partner in retirement. He's been waiting patiently while you got that tax deduction every year you contributed. Now it's time for him to collect. Let's talk about what this actually means in dollars and cents. If you've got $1 million in your IRA and it grows to $1.5 million, by the time you hit age 73, your required minimum distribution in that first year could be around $56,000. Add that to your Social Security, let's say $40,000 for a married couple, and suddenly you're looking at nearly $100,000 in taxable income, and that's before you've taken a single dollar for your actual living expenses. For 2025, that puts a married couple filing jointly right into the 22% federal tax bracket, with the top portion potentially hitting 24%. But it's not just federal taxes you need to worry about. Let me walk you through the 7 tax surprises that almost no one talks about until it's too late. Surprise number 1, IRMA, the Medicare surcharge most advisors never mention. IRMA stands for Income-Related Monthly Adjustment Amount, and it's one of the most frustrating stealth taxes in retirement. Once you turn 65 and go on Medicare, your premiums are based on your income from 2 years prior. For 2025, if your modified adjusted gross income exceeds $106,000 as a single filer or $212,000 filing jointly, you'll pay higher Medicare Part B and Part D premiums. The standard Part B premium is $185 per month, but if your income pushes you into the first IRMA bracket, you'll pay $259 per month. That's an extra $888 per year per person. And it gets worse as your income climbs. At the highest bracket, over $500,000 for singles or $750,000 for couples, you're paying $628.90 per month for Part B alone, plus an additional $85.80 per month for Part D. That's nearly $8,600 per year in Medicare premiums for one person. Here's the kicker. This is based on your income, not your need. So those big required minimum distributions from your $1 million IRA, they can push you into these higher brackets even if you don't need the money. Surprise number 2, required minimum distributions that force you into higher tax brackets. RMDs are perhaps the most predictable surprise, yet somehow they still catch people off guard. Starting at age 73 for most current retirees, or age 75 if you were born in 1960 or later, the IRS forces you to withdraw a percentage of your pre-tax retirement accounts every year. For a hypothetical scenario, imagine someone with $1.2 million in their IRA at age 73. Their first RMD would be approximately $45,000. By age 85, it could exceed $80,000. Now add Social Security, maybe some pension income, and suddenly you're being forced into the 24% or even 32% tax bracket. Not because you're spending more, but because the government is forcing you to take distributions you might not even need. Surprise number 3. Up to 85% of your Social Security becomes taxable. Most people know Social Security can be taxed, but they don't realize how aggressive this taxation can be. If your combined income, which includes your adjusted gross income, tax-exempt interest, and half your Social Security benefits, exceeds $44,000 for married couples filing jointly, up to 85% of your Social Security becomes taxable. Guess what pushes you over that threshold? Those required minimum distributions from your 401k and IRA. This is a classic case of one tax problem making another tax problem worse. Surprise number 4, the surviving spouse tax trap. This is one of the most devastating and least discussed tax issues facing married couples. Here's what happens. When one spouse passes away, the surviving spouse goes from married filing jointly to filing as single. The tax brackets for single filers are roughly half as wide as those for married filing jointly. Let's look at a hypothetical example. Consider a couple with $150,000 in annual taxable retirement income. When both are alive and filing jointly, they're comfortably in the 22% bracket. But when one spouse dies and the survivor still has that same $150,000 in income, because those RMDs don't stop, suddenly a much larger portion of that income is taxed at 24% or higher. Plus, that surviving spouse now faces the single filer IRMA threshold of just 106 instead of 212. Their Medicare premiums can jump significantly overnight. Surprise number 5, net investment income tax. If your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 filing jointly, you'll pay an additional 3.8% tax on your investment income, including capital gains, dividends, and interest. Large RMDs can push you over this threshold, triggering thousands in additional taxes. Surprise number 6, state income taxes on retirement income. 13 states tax Social Security benefits to some degree, and most states tax IRA and 401k withdrawals as ordinary income. If you live in a high tax state like California, New York, or New Jersey, you could be paying an additional 5 to 10% on top of your federal taxes. Surprise number 7, double taxation on after-tax contributions. If you made any after-tax contributions to your traditional IRA or 401k over the years and didn't keep meticulous records, you could end up paying tax on that money twice. Once when you contributed it and again when you withdraw it. This requires filing Form 8606 and maintaining good records, something many retirees overlook. Now, your current advisor might tell you that you're well diversified, and maybe you are, across different asset classes. But here's what really matters in retirement: tax diversification. Tax diversification means having money in 3 different types of accounts. Pre-tax accounts, like traditional 401ks or traditional IRAs, you pay taxes when you withdraw. Roth accounts, Roth IRAs or Roth 401ks, you already paid the taxes, so withdrawals are tax-free. And after-tax accounts, regular brokerage accounts. You pay taxes on the gains. Why does this matter? Because having money in all 3 buckets gives you flexibility. In a year where your income is low, you can pull from your pre-tax accounts and fill up those lower tax brackets. In a year where your income spikes, maybe from a large RMD or selling a property, you can pull from your Roth accounts tax-free to avoid pushing yourself into a higher bracket. This is where strategic Roth conversions come into play. A Roth conversion is when you move money from your traditional IRA or 401k into a Roth IRA. Yes, you pay taxes on the conversion amount in the year you do it, but once it's in the Roth, it grows tax-free forever. And you never have to take required minimum distributions from it during your lifetime. The sweet spot for Roth conversions is usually in your early to mid-60s after you've retired and your income has dropped. but before you start taking Social Security and before RMDs kick in. During these years, you might be in a lower tax bracket than you'll ever be in again. Imagine someone who retires at 62 with $1.5 million in their traditional IRA. If they wait until age 73 to start RMDs, they'll be forced to take out large amounts at potentially higher tax rates. But if they start doing strategic Roth conversions from age 62 to 72, let's say $80,000 per year, they can pay tax at the 22% rate now to avoid paying 24% or 32% later. Plus, every dollar they convert reduces their future RMDs, which can keep them out of those higher IRMA brackets for Medicare. And if they pass away, their heirs inherit a Roth IRA instead of a traditional IRA, giving them tax-free withdrawals. Here's the key. Roth conversions need to be strategic. You don't want to convert so much in one year that you spike your taxes unnecessarily. This is where comprehensive tax planning comes in, something a traditional investment advisor typically doesn't provide. You've probably heard the term comprehensive financial planning or plan-led approach thrown around, but what does it actually mean? A traditional investment advisor focuses on one question: how should we invest your money to maximize returns within your risk tolerance? That's it. They pick the funds, rebalance the portfolio, and send you quarterly statements. A plan-led approach asks a completely different set of questions. When can you comfortably retire? How much can you spend in retirement without running out of money? When should you start Social Security to maximize lifetime benefit? Which accounts should you withdraw from first to minimize taxes? How can you reduce your lifetime tax bill by $100,000, $200,000, or more? At MOKAN Wealth, we call this the 5-seed system, a retirement planning framework specifically for 7-figure savers. It addresses the 5 key areas of retirement planning: income, taxes, investments, healthcare, and legacy. Notice that investments are just one of the 5 areas. Your investment returns matter, of course, but here's a truth that might surprise you. For 401k millionaires in retirement, the difference between a 6% and a 7% return on your portfolio might add up to $50,000 over 10 years. But the difference between a good tax strategy and a mediocre one, that can easily be $200,000 or more. Let me address the 2 things I hear most often from people who come to us. Objection 1, I already have an advisor. I hear this all the time, and my response is always the same. That's great. But let me ask you, is your advisor primarily focused on managing your investments, or are they actively helping you minimize your lifetime tax bill? Many traditional advisors are excellent at what they do, but their expertise often ends where your most significant retirement challenges begin. Managing a diversified portfolio is table stakes. What you need now is someone who can navigate income planning, tax planning, healthcare planning, and legacy planning, all working together. You wouldn't hire a cardiologist to treat a broken leg, right? It's not about finding a better advisor. It's about finding the right advisor for this specific stage of your financial life. Objection 2. I'll figure it out later. This is the one that keeps me up at night, because time is your most valuable asset when it comes to executing tax strategies. Every year you wait to implement Roth conversions, that window gets smaller. Every year you delay planning, those RMDs get closer. Every year you kick the can down the road, you're limiting your options. I've seen too many people come to us at age 70 or 72 saying, I wish I had known about this 5 years ago. And the truth is, we can still help them. But we've lost valuable years where we could have been filling up lower tax brackets, converting money to Roth accounts, and implementing strategies that would have saved them 6 figures in taxes. If you're in your 50s or early 60s, you're in the sweet spot. If you're already in your late 60s or 70s, it's not too late. But every year matters. Here's the bottom line. If you've built $1 million or more in your 401k and IRA, you've done something most Americans never achieve. You've been disciplined. You've been smart with your money. You've sacrificed to build this nest egg. But the planning that got you here, maxing out contributions, letting it grow, trusting your investment advisor, that's not the same planning that will get you through retirement tax efficiently. You need a different kind of advisor, one who sees the tax surprises coming and helps you avoid them. One who models out your RMDs, your IRMA premiums, your surviving spouse situation, one who treats your retirement like the complex planning challenge it actually is. At MOKAN Wealth, we help self-made 401k and IRA millionaires keep more and pay less in taxes. We don't ignore your favorite uncle, Uncle Sam, but we make sure he only gets what he's legally owed, not a penny more. If you want to see how we can help you create a tax-proof retirement plan, subscribe to the channel or click the link in the description to have a discussion. You've worked too hard to let poor tax planning steal your retirement dreams. Let's make sure that that doesn't happen.